And welcome to our, what I now understand to be our 9th webinar, Thursday, the 21st of October 2021, Maximising Tax Relief for Landlords' Expenses. About this webinar, it's a tax-centric talk. If you didn't think it was anything other than tax-centric by now, you're probably in the wrong webinar. To cover OMB property businesses, and we're going to look at how landlords may use the new cash basis and the accruals basis to best advantage as we claw our way out of the pandemic. The grim spectre of rising interest rates, the grave implications of incorporating a property business, making tax digital, the grisly truth, and the hidden costs lurking beneath a claim for using your home as an office. You may have spotted a trend here. I have a 9-year-old son. The little darlings that he goes to school with have basically told him that Santa is kaput, but apparently zombie apocalypse, we're still on for that, 100% for Halloween. So, you know, start as you mean to go on. Okay, clawing your way out of the cash basis. The real reason why HMRC's introduced the cash basis is to make their lives easier, not yours. Now, I know that there are a few accountants who watch these webinars, and you know, people in the profession are quite comfortable with accruals. It's not that difficult a concept to grasp, to be fair, but HMRC's never really understood it. So they, you know, much prefer cash basis, much simpler for them to get a grip of. Now, most landlords are paid in advance. So if you have to recognize income when it's paid and you're paid in advance, then instead of under the cash basis, the landlords, instead of allocating it to the tax year it is paid for, you have to recognise your income tax or pay income tax on that cash receipt the sooner. So, first example, Shanti has 6 properties, each let out at £1,000 per calendar month, payable at the end of the previous month. So she lets HMRC slide her into the cash basis in 2021-22. The £6,000, 6 lots of £1,000 that she receives at the end of March 2022, which is received at the end of the 21-22 tax year, but which is actually for April, under the old regime, the traditional accounting basis, accruals basis, she would have ignored that. It belongs to 22-23, but under the cash basis, you get hit as you receive it, regardless of the fact that it's actually for the coming month, for the coming tax year. So it would be added to her 21-22 income. So that's basically an extra taxable profit of £6,000 in 2021-22. Now that is one of the main reasons why I am averse to the cash basis for landlords, and it, generally speaking, is a decent one. Reasons for the cash basis, well, it is more straightforward. There's no denying that just monitoring cash in and cash out is more straightforward than having to adjust and get a more accurate perspective of the, you know, your business performance. And it is good if you have poor paying tenants. So I don't know, let's say there's been some kind of a global catastrophe that means that people have been unable to pay their rent on time. So let's dive back into the example of Shanti. Shanti's tenants all stopped paying, very accommodating her tenants. They've all stopped paying at the beginning of 2021. So the last payment they made was December 2020 for January 2021. So under traditional GAAP accruals basis, she still has to recognise the rent owed Jan 21 for Feb 21, and then Feb 21 for March 21, so that's 6 lots of £1,000 each month. And in theory, that money is still owed to her. So under the sort of traditional basis, she should start off recognizing that income that is owed to her, even though it's not physically being received. She then, under the traditional basis, has to think about making provisions or deductions for bad or doubtful debts, etc., etc. However, if Shanti instead adopts the cash basis in 2021, she simply says, I haven't had the money, I don't care, I'm not taxable on it. It's very straightforward, it's very simple. So there is an argument in these circumstances for adopting the cash basis. Now, there is an argument then for saying, why should we tarry in the cash basis? You know, you don't have to stay, you don't have to linger. If we assume that all Shanti's tenants catch up in 21-22, fantastic, she'll receive an extra 12 grand in cash in 21-22 when they finally sort of get back onto an even keel. If she stays in the cash basis, that extra cash that she receives in that second year, she has to recognize that as income and it's taxable in 21-22. So over the 2 years, she's back to square one kind of thing. What if she decided to revert back to the good old-fashioned gap accruals basis in 21-22 and said, well, that money that these tenants actually paid me this year but owed for last year, it's not taxable this year. It actually belongs to the previous year. Well, obviously tax law doesn't let that extra 12 grand that belongs in the previous year fall out of charge completely if Shanti reverts back to gap. But it does let her spread that £12,000 adjustment for change of basis over the next 6 years evenly at £2,000 per year. In fact, ITOIA 2005, section 333, section 239A applies automatically. She doesn't even have to ask. It's in the legislation already. This isn't really something that is unusual. The legislation prescribes it, that adjustment. And that could be quite useful from a cash flow perspective. From a tax cash flow perspective, I wouldn't necessarily recommend it unless there were a fairly substantial amount of sort of income in arrears in the first place that snaps back conveniently in the following year. So if you were motivated or otherwise ended up on the cash basis in 1 year because of a lot of arrears, let's say, and then those arrears made good substantively in the following year, that might be a good time to contemplate going back to the traditional accounts basis. Moving on to the grim spectre of rising interest rates. A couple of headlines from the last few weeks. Interest rates set to rise as soon as February, I think they mean February 22, amid inflation surge. Inflation will rise above 4%, more than double the Bank of England's 2% target, raising expectations of a hike early next year. That was a Telegraph. UK interest rate rise in 2022 becoming more likely, says Andrew Bailey, Bank Chief. We are monitoring the situation closely. Well, so what? Inflationary pressures themselves signal higher costs generally. So your building and maintenance costs have rocketed because of scarce materials and scarce skills. Now, inflation is normally a factor of sort of monetary value, so that tracks the materials, but actually it also means you've had to wait an awful lot longer for maintenance work to be done. You know, plumbers, electricians, etc. They are very much more in demand, but also they don't necessarily have all the materials that they need to do a job. So it's very inconvenient. When inflationary pressures then translate into an interest rate rise, that in turn feeds into higher mortgage and finance costs. For residential property landlords, that means higher disallowances. higher disallowed interest costs, that can push the taxpayer into higher rates of tax. I'm going to give you an example now. I've steered clear of names like Eduardo. So now we've got Austin. Austin is a landlord with a portfolio of 7 properties, typically yielding 42 grand in net profit after £8,000 worth of mortgage interest annually. Wife Olivia is a part-time GP, earning 54,000 per annum. She also pays into a private pension. They have 2 kids under the age of 16. Just a little bit of background. In 2022-23, interest rates rise by 0.75%. So Austin's interest costs increase by, say, 6,000. So if we assume that Austin is paying £8,000 annual interest on a 1% buy-to-let mortgage, let's say, an increase of 0.75%, which, let's face it, is not that large an increase historically. It would be a huge increase in sort of today's money. But over the years, 0.75% in the space of a relatively short period of time has happened sort of quite often. That would result in is 75% more interest, or 14 grand annual cost of interest. Now, if Austin had done nothing, his profits would fall to 36,000 after knocking off an extra 6k because of increased profits. But he can justify passing on that extra higher interest cost because the demand for rented property is still strong, and the cost of buying as against renting will basically have gone up in the same way. So it's not as if renting has suddenly become much more expensive than buying. It will basically treat buy-to-let mortgages broadly the same as home buying mortgages, and therefore, if mortgage interest rates rise in one sector, it's probably going to have the same effect in the other sector as well. So charging an extra £75 per month per property actually adds 6,300 back in gross rents. Ignore any fee changes. Let's pretend there's no letting agent or anything like that. So he ends up to within a few hundred quid back where he was. The problem, though, is that he's added back a lot more interest. So in 2021-22, Austin's income tax bill is 5,886, which I'll take my word for it. In 2022-23, Austin's income tax bill is 8,303. It's gone up by £2,400. Half of that is down to the fact that he's now pushed the interest added back, disallowed initially because he has dwelling-related finance costs, buy-to-let mortgage interest, etc., has pushed him significantly higher into the high rate threshold. That's also had a nasty consequence, and you might now spot why it is that I've added that little bit of background of having 2 kids under the age of 16, etc., etc. The increased interest by increasing his rents so that he doesn't lose out on profits because of increased interest. That increased interest now goes even higher into the high rate threshold. That means that it becomes the higher earner in the couple, and therefore child benefits clawed back from him as an effective tax bill. So that costs him an extra 1,200 quid. The interest disallowance itself costs him an extra 1,200 quid on top. So you're talking £2,400 effectively just for treading water. Now, some people might have said, oh, hold on a minute, why isn't Olivia paying the child benefit high income clawback? It's the same, she would have been paying it beforehand. Now it's on him. So really across the couple, it's not really a net tax cost. Well, I did say she paid into a private pension. So her income in this scenario is less than 50 grand. So she would not have actually gone, her adjusted net income would not have gone over the 50k to trigger the high income child benefit clawback. It's not my first rodeo with this, Okay, grave implications of incorporating. incorporating a buy-to-let property business can be quite difficult or expensive. For example, you've got these initial thresholds, these initial pitfalls to navigate. There's a risk of capital gains tax on transferring the properties to a company you also own. So even though you might not actually charge any money because you own these valuable assets, and you're the shareholder in this company, you're both you are connected with a company, therefore, even if it's a gift, is deemed to be at market value. You may be able to claim capital gains tax incorporation relief to postpone the capital gain into the shares. It's not a given, it's not automatic, although landlords, landladies who run a substantial property business will have, as a rule, a strong case for arguing that it's a business that is capable of being eligible for incorporation relief. Risk of stamp duty, land tax, or the devolved flavours, land transaction tax, LTT, land and buildings transaction tax in Scotland, typically do when the connected company acquires residential property from a shareholder in that company, connected party. But again, you may be able to benefit from the special rules on incorporating partnership. Again, it's not a given, it's not automatic. Even if you are a partnership and you qualify as a partnership, that doesn't necessarily mean you would get the relief. There are anti-avoidance measures to navigate. Annual tax on enveloped dwellings. Now, on any single dwelling worth more than 500 grand in a corporate wrapper, you have to worry about ATED, annual tax on enveloped dwellings. Even if it becomes worth 500 grand some years down the line, it could have been bought for 400,000 and today be worth 500. So next year you would be worrying about ATED. Isn't it strange how HM Treasury starts off introducing this annual tax on enveloped dwellings, high value properties, anything over 2 million. And even though house prices are rising, you could argue that 500 grand isn't really that high value. Besides, 2 million is too high, 500 grand is actually where the threshold should be. Anyway, so you're okay with ATED. You have to check every year. You're okay with ATED provided your dwellings are being let on a commercial basis to unconnected parties. If you let a high value over 500 grand property, not the cost of value. So again, this is something that if you have relatively high value rental properties, in theory at least, you should be checking every year to make sure have any new properties tripped, or have any properties newly tripped over that threshold, and am I letting it to my nephew or my auntie or my son? Because even if it's purely arm's length, purely commercial basis, it has also to be not to a connected party. There's a rule about a non-qualifying individual, and non-qualifying individual primarily is where they're connected with somebody who has an interest in the company itself. Finally, ongoing tax costs, profit extraction, the kind of vanilla stuff that we look at. The dividend income tax increase alongside the health and social care levy introduced. Well, the health and social care levy itself isn't introduced from April 2022 because that would be too straightforward. We have increases in national insurance contributions temporarily while they get their act together and bring in the proper health and social care levy from April 2023. But from a computational perspective, it is practically the same unless people are just about to retire, in which case there's a slight discrepancy or difference between the two approaches. Corporation tax rates increase April 2023. So yeah, it's becoming more expensive all round. So we're back to Austin with his rental profits of 42 grand and mortgage interest of 8k rising to 14k. So Would Austin want to incorporate? Let's put to one side the thresholds, the sort of pitfalls on, initially on incorporating his business. Let's just look at, let's assume he gets through all that unscathed and he's happily incorporated. And he did it at the beginning of 2021, 2021, 22. We know, because I've told you, that unincorporated his income tax bill was 5,886. If he instead run the portfolio through a company, taking a salary of 9,000, the rest of the post-corporation tax profits and dividends, he would have been about £2,000 worse off. And that's with a fairly substantial sort of mortgage interest bill as well. In 2022-23, remember, this is the year when the interest has sprinted from 8,000 per annum to 14, and when he was unincorporated, those pesky kids were costing him an extra 1,200 quid and clawback of high income child, clawback of child benefit as well. So it was hurting him. The income tax bill jumped to 8,303. If he'd instead have run the portfolio through a company, taking a sum of £9,000, dividends on the balance, he would have been £100 better off. On these figures, the 2023-24 increased corporation tax rates, remember, he's just bubbling under 50k, or he would be after taking £9,000 salary off his portfolio profits in the company. He's bubbling just under the 50k mark. So actually, even though you're going to have higher corporation tax rates coming in from April 2023, you have that safe harbor for the first 50,000 annually, assuming you don't have any associated companies to complicate matters further. You have that safe 19% small profits rate for your first 50k. So he would still be taxable at just 19%. And he would not really suffer any better or worse. He'd be holding on to that 100 quid saving with both hands. Now, if Austin had also had another source of income, so let's say for the sake of convenience, that he worked part-time down at Tesco's or something like that, just for kicks, or he decided to go and help the nation by driving an HGV, hopefully not in reverse, into a fence. Incorporation would help him more there, because with that extra 15 grand of personal income on an unincorporated basis, if it were all personal income, throwing that 15k into the pot, he'd be well into high rates of tax. He'd be suffering quite badly from the add back of interest relief on when paying income tax. So actually, it would save about 2,600, maybe a bit more per year. Is that worth all the hassle of incorporation? I couldn't say. I think it would depend on how easy it would be to incorporate, and also the fact that maybe a 0.75% increase in the rate of interest is just the start. It's just the beginning. We don't really know where this is going to end. We don't know whether it's going to go up to 0.75% and end up at 3%. We just don't know at this stage. So the case for incorporation may get stronger, or it might not. Okay, making tax digital the grisly truth. Unless you've been living under a rock, or you've just had far better things to do in your life, then you will have heard of making tax digital. And maybe you've been ignoring MTD. I know I have. I've been hoping it would go away. I'm in denial, very much so. I advise on it. I know the legislation. I've studied it, and I loathe it with a passion. That's just me. It's unlikely that my distaste for MTD is going to sway the government or the powers that be to refrain from introducing it. So we are where we are. It looks like most VAT registered businesses are already caught, most landlords, property businesses are not within the scope of VAT. As non-VAT businesses, if I can put it that way, they will really only have to worry about MTD from April 2024. I think 3 weeks ago, it was April 2023, but it's been pushed back yet another year. I call that a win. But as I say, singleton businesses, and remember that most co-owned property businesses are not partnerships, certainly as far as HMRC is concerned. So if it's husband and wife, civil partner, family members, etc., and it's a passive property portfolio where you're just kind of sitting back, watching the money roll in, then you're almost certainly not a partnership. You'll be just mere joint investors. April 2024 will be your start date. Partnerships might be April 2025, could conceivably come in later because they are more complicated, but we have the legislation now. We've had draft legislation rattling around since, I think, 2017. But that has been laid before Parliament and approved. So we are go. Why do we care if it only means a few more online returns a year? If you're used to VAT returns, say, then who cares? Well, it does mean several more returns or updates per year per business. So it's conceivable, and remember, George Osborne, July 2015, summer budget, the end of the annual tax return, and we all went, yay. And what it actually meant was you're not going to be doing one tax return per year, you're going to be doing loads. So it's technically 4 quarterly updates, an end of period statement, and your tax return itself, and the first 4+1 is per business or are per business. You can have loads come going out of your ears. That isn't the real issue. The real issue is that under NTD, digital record keeping is mandatory, or as now appears to be the fashion, mandatory under NTD rules. You must basically use HMRC approved software, because HMRC is allowed within the regulations to specify the software, the criteria to meet its approval. So you are having to use HMRC approved software to keep your own business records, and they must be digital. Now, there are some people who say, I'm all right with that, that's fine. Personally, that sets my teeth on edge. If there's software out there which is good and useful, I shouldn't need to be forced to use it. That is what annoys me. And the other point is that if you have quite a complex property portfolio of businesses or whatever, and you have numerous software packages, they all have to be able to talk to each other and update each other automatically with the press of a button. Humans are bad. Computers are good. You can't even cut and paste anymore. You can't sort of have a report on one side from one software package and just key it in. Even if you reconcile, no, that's got to go. You just have to press one button in one software and it has to update the other software or get piped across to HMRC automatically. Now, there are lots of software packages out there that do that, but I am loath to endorse a software package that has been devised from the beginning merely to comply with HMRC's criteria. I'd much rather have a software package that was designed to give you all the benefits of having digital record keeping anyway, and be online or computer oriented setup in the first place, that is then MTD enabled. So why do we think that HMRC is introducing Making Tax Digital? It's forcing businesses to update their records more frequently. You know, in the profession, we're long used to clients who come once per year and just drop off all their books and records, pieces of paper, bank statements, etc., receipts, till slips, and say, there you go, those are my accounts, let me know a couple of weeks when you're finished, and that's it. But now HMRC is basically trying to force people to update their financial records at least quarterly, and the regulations actually require you to update your financial records effectively every 3 months. The reasoning behind this, and this is HMRC's logic, not mine, is that businesses, people will pay more tax, in HMRC parlance, to narrow the tax gap. This is not how they try and sell MTD to Joe Public. Please spend more money and time adopting new systems, buying software, buying laptops, smartphones, God knows what else, with the end result that you will end up paying more tax. Tough sell. It is quite right to point out there could be lots of fringe benefits, soft benefits to adopting MTD. But again, I go back to the point that if there is software that's good enough to help you and to improve your business records and the information that is coming back to you, then why would you need to be forced to do it? HMRC really does not care about the extra time, cost, inconvenience to you. Genuinely. I cannot believe that an organization that imposed real-time information reporting for pay-as-you-earn a few years ago and said, this is going to be ace, it's going to be fantastic for businesses, it's going to be brilliant for us and for you, and then did a report or a sort of investigation of how real-time information reporting, you know, online and purely digital payroll management actually went for small businesses and went, oh, quelle surprise, it was actually much more expensive than we'd imagined it would be for your average small business, and extremely time-consuming for the advisors for small businesses. And lessons learned, let's make sure we don't make that, oh, MTD. Okay, so, you know, the other thing about this is that HMRC also wants to use your financial information, because it's very valuable to HMRC and to other government departments. HMRC with simply assessing and collecting tax is boring. Any old fool can do that. In fact, it's managed to offload its burden of assessing and collecting or accounting for tax to you guys, for running payroll, doing VAT returns, filling in your own tax returns. So HMRC quite fancies styling itself as a Ministry of Financial Information. And I think this is really genuinely how HMRC sees itself as moving forward in the 21st century. You got a whiff of that in some of the comments that were made around the time of the pandemic, when government ministers, particularly the Treasury, were saying, oh, if only HMRC had more up-to-date information, we wouldn't have had to do X, we'd have been able to do Y, we'd have been able to do it much faster, we'd have been able to get much more tailored assistance out to businesses. And I'm thinking, oh yeah, okay. Also, because all these records, all this information is becoming standardized according to the criteria that HMRC sets out, don't be surprised if you find that in a few years' time, you get digital audits of your financial records out of the blue. You know, particularly if your record keeping is cloud-based. Okay, claiming for use of home as office. Many business owners have been forced to run the business from home over the last couple of years, thanks to the pandemic, although landlords have generally been doing this anyway for many, many years. Have you been happily claiming £4 per week, now £6 per week, for the last several years? Hidden costs. Will I have to pay CGT on my home when I sell it? What about business rates? Does running my business from my home mean that I'll suddenly find that I'm liable to business rates? And really, if it's only £6 per week or 312 quid per year, then, and then only if I sort of spend at least 100 hours per month running my property business, is it worth the hassle? I'm going to take those one by one. Okay, so am I exposed to capital gains tax? Now, if I use a spare bedroom as an office, doesn't mean, say, a sixth or a seventh or an eighth, depending on how many rooms, living rooms there are in the property, will no longer enjoy PPR or main residence relief. The answer to that will almost always be no. The legislation says it has to be exclusive business use. And HMRC says the exclusive use test is a stringent one, and you should not usually seek any restriction to relief for a room which has some measure of regular residential use. Occasional and very minor residential use should be disregarded. And one of the examples given is of, say, a house which has been given over partly to operate as a GP surgery. The rooms that are waiting rooms or attending rooms would clearly be used almost exclusively for business purposes, and therefore would, the overall property would be restricted accordingly. So a spare bedroom or even a study. I don't think a study will be used exclusively for business purposes if you conduct personal, private, domestic matters there as well. Possible risk areas: when the room is used very rarely for domestic purposes. An example might be you store stock. Let's say you are doing a spot of eBay or Amazon trading, but proper, mail order coming in, you've got to store inventory, etc., and you use one room, and that is dedicated to sort of running things from there. Then, yeah, it's possible that you might suffer restriction. Hairdressing. So again, you've got clients coming into the house, and you have to keep a room particularly neat and tidy. Can't be occupied domestically at any time. Maybe it's been partly adapted to sort of fulfill a sort of special function. GP surgery, I mentioned that already. But on the whole, you'll be fine. Business rates. If I use a spare bedroom as an office, doesn't that mean that I may have to pay business rates? Again, almost always the answer will be no, unless have you adapted the property, structurally speaking, so that part of it or all of it has lost its domestic character? Have you installed some kind of equipment that is not normally used in a domestic setting? Well, dentist chair, for example, that kind of thing. Do you employ non-family members at the property to work in the business? Or do clients or customers attend the premises for business purposes? These are very, if you think home office on the one hand, these are extremely unlikely, I would argue. And you can take some comfort from the case Tully versus Jorgensen 2003, which I find memorable because the Inland Revenue lost to the Inland Revenue. In sort of more detail, this was a revenue employee who was suffering from a chronic back injury, I think, and was working from home for some time. And another part of the revenue said, "Oh, you should be paying business rates now." Now, found for the employee, business rates were not due. The inland revenue employee was successful in convincing the Lands Tribunal that the Home Office should not be subject to business rates. It hadn't lost its essentially domestic character. And I think this is going to become increasingly important. I'm just going to read part of the case to you. A person in working at home could, nevertheless, be using his house for the purposes of living accommodation. Residential property in which an occupier works avoids being business rated, not simply where the use for the purposes of work can be regarded as de minimis, but also where such use is properly to be viewed as use for the purpose of living accommodation. The internet and email have enabled increasing numbers of people to work at home, where previously they would have had to go every day to an office elsewhere. In other words, the whole concept of home working has taken on, or is taking on, and all the more so in the pandemic, really falling under the auspices of standard domestic living accommodation now includes having a home office, for want of a better phrase. The question will always be one of fact and degree, however. So there's another case, and there's always an accountant pushing the boundaries. Another ratings tribunal case. This is an accountant who ran his business from home. This is sort of a more extreme example. Largely permanent use of several rooms for offices, filing, and storage. He employed unconnected staff. When I say unconnected, I mean not family members. Not people who would ordinarily have been part of his household, but effectively strangers to come to his house and work as accounts clerks or whatever. Regularly held client meetings and advertises home address in business listings. And in that sort of, I would argue, quite extreme case, that business rates were in fact due. So is it worth it? If I can claim a maximum of 300 quid at, say, 40%, that saved me £120, big deal. Now, actually, there is no legislative basis for applying the simplified expenses rules regime for property businesses. The simplified expenses rules that say £6 per week or whatever are actually only for trading activities. But the simplified expenses regime is optional. But remember that when HMRC uses the word simplified or simple, it doesn't. When HMRC simplifies the tax regime, it will never cost HMRC money. You're sort of arguably trading more tax bill for the convenience of doing something in an easier way. You can claim for the actual running costs, heat and light. That is what the £300 per year, the £6 per week is for. And you can claim for an identifiable proportion of fixed costs. And I say private mortgage interest. What I'm trying to say when I say private mortgage interest is if I say mortgage interest, don't go back to your property portfolio and take 1/7 of your property portfolio as mortgage interest. What I mean is the mortgage interest relevant to your main home. Council tax, insurance, and even some repairs. And if you do that, it should be, I say easy or easier, and much more worthwhile to get significantly larger tax savings than £100 per year. And this is guidance from HMRC's Property Income Manual. Where a landlord genuinely runs the rental business from home, they may claim the extra business costs that they incur, such as the cost of extra lighting and heating. Where a specific part of their home is used exclusively for running the rental business for a significant amount of time, whether continuously or at particular times, then a proportion of all fixed expenses referable to that room may be deducted. So we're back to council tax, mortgage interest, insurance, that kind of thing. You may have spotted the insertion of the word exclusively for business purposes in that paragraph. That doesn't mean necessarily that by claiming a more comprehensive apportionment of fixed costs, you must also therefore be lining yourself up for a restriction of CGT relief, only your main residence relief, when you come to sell the property. It doesn't work the same way, although, again, there is a potential for both approaches to meet in the middle and therefore overlap. So what have we learned? Well, clawing your way out of the cash basis. Cash basis is often not helpful. I dislike it, but my opinion, what does that count for? If a landlord has had large arrears, for instance, the pandemic, then adopting the cash basis can make sense. But flipping back to the traditional accruals basis, the historic prepayments and accruals, etc., when cash flow improves again, will automatically spread adjustments on the change of basis evenly over the next 6 years, which could also be quite useful. Again, work it through. It's potentially quite beneficial if you've had meaningful cash flow issues which have then righted themselves the year later, in simplistic terms. The grave implications of incorporation. We learned last month, some of you may have blotted it from your minds, those wonderful diagrams and charts that I did that caused me no end of grief afterwards. We learned last month that the corporate options are becoming more expensive due to increased corporation tax rates where company profits exceed 50k, and the plus 1.25% hike in dividend income tax. It's making running a company more expensive. And there are threshold costs. Those are the initial steps to get your property business into the company. Rising interest rates will cost more, obviously. On its own, doesn't actually change the equation until the landlord does something to remedy the situation. Say, hold on a minute, my mortgage costs have risen significantly, my profits have fallen, I need to put my rent up. Once you do that, bringing the profits back up and then adding back even more interest on top, that is when you start ending up worse off after tax. So as long as you take the pain and don't complain, then the tax implications are nugatory. It's only when you actually try and do something silly like remedy the situation, then you're likely to suffer an extra hit on tax hit through your buy-to-let mortgage costs. Of course, assuming that it's going to push you into the high rate tax bracket over 100k, over 150k, where there's a change in the marginal rate of tax. The grisly truth of making tax digital: huge inconvenience and cost with no real benefit unless the software has effectively already been written for the client, for the landlord, for the landlady, for the business person, rather than simply to comply with HMRC rules. So what you want really is a software package that is client-centric, and MTD's done not as an afterthought, but sort of as a lesser priority than it being client-centric and doing what you want in the first place. Then I think you can argue that going digital is beneficial. But again, why would you need to mandate that? Hidden costs of use of home. A play on words, really. I don't think that capital gains tax or business rates will be an issue. I actually think the hidden costs are the ones you didn't know you could claim and quite possibly should be. I've got some questions, some Q&As. There's a ringer in there, see if you can spot it. I'm going to pronounce this Kazia. Please explain how to deal with increasing property value on the balance sheet. Always good to start with an accounting question. What I think you mean is that if you have to if you choose or have to recognize increasing value on the balance sheet, say because your properties have increasing value, does that cause any CGT problems? And the simple answer is no, because CGT is triggered only when there's a disposal. So merely showing that the properties have increased by 20% from 1 year to the next, that's not caused a sale, that's not caused a gift or other disposal, so that's fine. So revalue away. And to be fair, I mean, I'm no accountant, someone would say I'm not even a good tax advisor, but the point is that unincorporated businesses have much more discretion as to what they can show on their balance sheets. They're not obliged to follow any particular rules. Corporates are, and there are a number of regulations, on a better phrase, that require directors to ensure that their financial statements are updated, the balance sheets update to show the latest fair valuation, so to speak. However, having said value away, don't worry about it. If you're looking at a partnership, be very careful with chargeable partnership assets. I think you're highly likely to want to stick with historical cost basis, because if you don't, you may regret it if you bring in partners or partners leave, change the partnership share. Don't really have time to go into it, but I have mentioned Statement Practice D12 in the past, and that is a much easier ride for you if you've consistently stuck with the historical cost basis, not revalued anything in the interim. As another example of situations where revaluation does have tax implications, the one that sort of immediately sprang to mind for me was, again, in the corporate scenario, actual money investments, sort of corporate insurance investment policies actually now fall within the scope of loan relationships regime. So if you do revalue according to GAR, then you would trigger a taxable credit, but that's not CGT, that's not property. That is a specific money-oriented investment. Brenda, I'm considering selling one of my BTL properties and will want to use the remaining proceeds to buy another property nearer home. Will I be able to claim rollover relief? Also, what is the position tax-wise if I make a loss from the sale? Now, there is no CGT relief for reinvesting the proceeds disposal of an ordinary rental business property and then reinvesting it into a new rental business property. There is rollover relief, strictly replacement of business assets relief, when replacing trading premises, for example, or property that qualifies under the special furnished holiday accommodation regime. That is one of the major sort of benefits, if you will, of using property that qualifies as a furnished holiday let. But generally speaking, the vast majority of rental businesses, their properties will not qualify for any kind of incorporation relief. You could postpone the gain by investing in special qualifying assets, not more property. These assets such as Seed Enterprise Investment Scheme or EIS. But professional advice from an IFA is absolutely essential, not just because I'm not a qualified financial advisor, but EIS shares are universally acknowledged to be high risk. So you would want to be very comfortable with what you are doing with your money, so to speak. As regards a capital loss, you must claim your capital loss. It must be claimed on your tax return. Once you do so, then it's in the bank, so to speak, for use against any future capital gains 5 years down the line, 10 years down the line, whenever, assuming it isn't automatically used in the year that the loss arises against gains in the same year. And there may be a planning opportunity there as well. But if you don't claim it, it's lost, it's forfeit. Once you claim it, it's there forever. But if you don't claim it, you can lose it. There is also a way to use incorporation relief and actually incorporate the property business. If you're looking at making a very substantial gain in the near future, perhaps you've got a particular property that you want to market for sale, and you know there's a very substantial gain, you can actually deliberately use incorporation relief in a particular way to effectively do that very sort of capital gains tax efficiently. But it would need to be a sort of very profitable disposal that you were contemplating for that all to be worthwhile. And on. While working as a GP, I used part of the house as an office and claimed a percentage of expenses against tax. I have now retired and will no longer claim expenses against tax arising from the use of the house. Do I remain liable for CGT if I sell the house because I've used some of the property for a home office? And if I do remain liable, Is it there forever, or is there a sliding scale that over time it will effectively attenuate the sort of exposed gain? Anon, or Dr. Anon, or Dr. Anon retired. I'm not sure you are or ever were liable for CGT in respect to the business use of your main residence. We've touched on this, and I deliberately went into a little bit of detail on that because I think it is important. In order for the CGT relief to be restricted, business use must be exclusive or practically exclusive. If you gave over a room in your home to use as an office and never used it domestically, then fair enough, you might have that sort of exclusivity. But my home office, I don't know whether you can see, is used to store children's toys and occasionally to store children. And I will sometimes watch Netflix. And you think bugs over here is just method in the madness. Even if there is exclusive use, and even if your advisor has reviewed the circumstances and has sort of considered it carefully and said, yes, there will be a restriction because the use was that exclusive. If that is the case, then over time, as your period of ownership extends, then the restricted element will be diluted or dissipate over the entire period. So yes, it will sort of wind down or wind out. Chris, I recently purchased a property using a limited company. The deposit was lent by me personally as a company director, transferred through the business account, 30K. I read online that I can charge my company loan interest, good, and up to £1,000 savings income can be tax-free, good. How should this be arranged so as not to cause problems with HMRC? Also, is it necessary to write any contract between the company and me? My accountant wasn't helpful. Why are they ever? He said he will have a look on that when the return will be due. I had to include this. He also told me to stop quoting web pages at him. Chris, there is absolutely nothing wrong with charging interest to your company as a lender, provided the interest is charged at no more than a commercial rate. If you take the time to establish what your company, the rate your company could have borrowed 30K at from somebody on the high street or an arm's length lender, and you adopted that rate yourself, you're golden. There's no problem. Now, a formal agreement, some documentary evidence as regards the loan, would be helpful. But I would argue it's not actually essential. Another couple of points. I don't know how much your total income is. Obviously, one might well know why. But the savings allowance does fall to £500 a year if you are basically a higher rate taxpayer. So it isn't always going to be £1,000. If you're earning if your income is £90,000, then it's not going to be a grand. The most you'll be able to get tax free is 500 quid. And again, there's always the concern that the disallowed interest on a non-corporate buy-to-let mortgage might nudge you into high rates of tax, even though you didn't know that you were actually exposed in that way. Your company will also need to observe the CT61 regime when making payments of interest. I would say it's perhaps a little bit late to look at all this after the end of the tax year when you're about to prepare your tax return. If you charge excessive interest, then the excess would generally be considered as a post-corporation tax distribution of profit rather than being allowable for the company. The reason why we say don't charge an excessive rate is because your company wants to be able to claim tax relief on making the interest payment to you as well. Stephen Lucas, aged 9 3/4, having laid out substantial amounts of pocket money to undertake the fortifications I deem necessary to repel the zombie hordes next Sunday, can I please get tax relief on said expenditure? After all, it was absolutely required for the business survival. Very well put together question for a 9-year-old there. Dear Lucas, thank you for asking such a salient question. Many landlords and some advisors mistakenly assume that just because an expense is necessary, it must be allowable for tax purposes. Strictly, a property business expense does not have to be necessary, although it does have basically to be incurred in order to benefit. You need to show that there's a reason why you've laid out the money to benefit the business. But in particular, note the expenditure that has an enduring benefit to the business, such as, and this is a classic on this, is when you've got an HMO and the local authority comes in and says, the electrics aren't good enough. You need to install to a higher standard. They need to be fire rated for 30 minutes. You go, okay, I've got to do this, otherwise I can't let it. Therefore, it must be allowable. Well, no, because you've made an improvement, a capital improvement to the property. And that means that you will only get the tax relief in some years down the line when you come to sell the prop, as long as the wiring is still there. Because if it isn't there, then that improvement isn't still part of the capital gains tax equation. P.S. I am concerned, Lucas, that you appear to own real property despite being under 18, and I think you need to check with a suitably qualified legal advisor to ensure that your title to property is secure.